Hello everyone, I am Luo Faxing, and today I will be presenting my final report on the real effect of share repurchasing legalization on corporate behaviors, a study conducted by Wang Yin and Yu in 2020. Here is the outline of my presentation. I will first cover the abstract followed by the data and sample construction. Then I will explain the empirical methodology before diving into the detailed results and the conclusion. First, let's begin with the main takeaways of the study. The study investigates how the legalization of open market share repurchases affect corporate behavior. The core findings are as below. First, contrary to the substitution hypothesis, firm does not substitute repurchases for dividends, but total payout increase. Second, the funds used for this repurchasing come primarily from internal cash rather than external debt, which align with the pecking order theory. Third, while buyback boosts short-term stock prices, they come at the expense of long-term investment. They reduce long-term investment and innovation, ultimately harming firm value in the long term. Finally, the main motivations of repurchasing are identified as tax advantage and the distribution of temporary earnings. Next is data and sample construction. This study outlines an extensive data set for its analysis. The data source includes manually collected legalization year, firm-level data from the Thomson Reuters WorkScopes database, and the country-level information from the Workbank. To create a clean sample, the study specifically excluded markets that have very few firms, which is less than 200, had insufficient data, hard pre-legalization, previous self-tender offer, or where firms did not repurchase within 2 years after legalization. The final sample used for the main empirical analysis is a large panel dataset consisting of 15,257 observations for 967 firms across 17 markets during the period from 1980 to 2018. And here is the sum table. The table 1 presents detailed information about the legalization year, relevant law referring source, timing, and deal number of the first repurchase case in this 17 market. And the figure 1 below presents the distribution of legalization years for the 17 markets. It illustrated how the legalization events were spread out over time, from 1982 to 2010. This staggered timing forms the basis of the difference in difference approach, and the figure 2 next to it presents the annual total number and the total value of share repurchases cases from 2 years before to 2 years after the legalization year in the 17 markets. It shows the dramatic change in repurchase activity post-legalization. And the table 2 in the right presents the summary statistic. Next, we enter the empirical methodology. The study used difference in difference design to isolate the causal effect of the legalization, and the YIJT is the outcome variable such as cash or R&D for firm I in country J at time t, and the coefficient of interest is the beta 1 on legalization dummy, which equal 1 after the reforms year in country J and 0 otherwise, and the XIJT denoted denotes firm level control variable, and the study also controls the firm and year fixed effect. And before conducting empirical analysis, the paper used Weibull hazard models to validate exogeneity. And after finding the main results, the paper conducted placebo simulations and parallel trends tests for robustness. So, before interpreting the main results, the paper confirmed the assumption of exogeneity, meaning the legalization event was not predicted by pre-existing economic or operational factors. And what is the Weibull hazard model? Unlike a standard binary model like probic or logic model, which is only as if an event happened, the Weibull model analyzes when it happened. It measures the hazard rate, the likelihood of legalization occur in a specific year. And the difference is it accounts for duration dependence, meaning it checks if the loss timing was driven by a country's economic trends. And from the table 2, we can clearly see that most coefficients on the macro and firm level variables are insignificant, which means that it proves legalization was unanticipated and exogenous, validated our DID strategy. Next, we can move on to the empirical analysis. And here is the impact of legalization share repurchase on firm payout policy as shown in the table 4. And the dependence variable here are repurchase, dividend, and total payout. The coefficient on the legalization dummy is the key result. First, for the repurchase in the column 1 and 2, the coefficient is both highly positive and statistically significant. This confirms that legalization leads to a substantial increase in repurchase. And for the dividend column 3 and 4, the coefficient is also positive but not statistically significant. And for the total payout, the coefficient is strongly positive and statistically significant, such as the 1.226 in the column 6 with a p-value smaller than 0.05. So we can have the conclusion that the legalization causes firms to distribute more cash to the shareholders, primarily through increased repurchase without reducing dividends. This refutes the strong substitution hypothesis. Next, in this page, Table 5 presents the impact of legalizing share repurchases on a firm financing and investment strategy. We also focus on the legalization coefficient. First, for cash in columns 3 and 4, the coefficient is negative and highly significant, meaning firms draw down their cash holding. And for capital expenditure in column 5 and 6 and R&D in column 7 and 8, the coefficients are also negative and highly significant respectively, indicate a cutback in long-term investment. And for the debt issuers in column 1 and 2, the coefficients are negative and significant in some specification. For example, in column 1, the coefficient is minus 1.808 and the p-value is 0.00, suggesting no increasing in debt to fund repurchases. And for the net assets from acquisition in column 9 and 10, the coefficients are generally insignificant. So we can have the conclusion that Firms finance the increase in share repurchases mainly by drawing down internal cash rather than issuing debt, and in doing so, they cut back on long-term investments such as capital expenditure and R&D. Then, Table 6 examines the short-term market reaction to the legalizing share repurchases, with buy and hold return and the abnormal stock return as dependent variables. The key finding is that the coefficient on the legalization dummy are significantly positive for both return measures. For example, for abnormal stock return in column 4, the coefficient is 12.08 and the p-value is also significant. And for buy and hold return in column 2, the coefficient is 12.1 with a p-value also 0. So we can conclude that this confirms a positive market reaction to the legalization of share repurchases, which is consistent with the existing literature. Then, this page addresses the robustness and validity of the core DID results. The study conducts placebo simulations by randomly assigning a pseudo-legalization year and re-estimating the DID model 3,000 times, and the 4 histograms of grade A to D shows the distribution of the placebo coefficients for cash, capital expenditure, R&D, and abnormal stock return. In each grade, the actual coefficient estimate, which is marked by the vertical lines, fall in the extreme tail of the placebo distributions, which means that the result confirms that the true reform effect is not driven by chance and is a genuine result of the legalization effect. Next page is also the endogeneity test. And this table performs a pretreatment trend test using event time indicator relative to the legalization year. The coefficient for the year before 2 and year before 1 are close to 0 and statistically insignificant across all independent variables. So we can confirm that the crucial parallel trends assumption of the DID design, that firms were not anticipating or adjusting their behavior prior to the reform. Conversely, the post-legalization indicator, which means the year 1 to 5 and after, are generally significant, showing that firms respond quickly once the law changes. Next, Table 5 and Table 9 examine the long-run impact on firm value and insider behavior. First, in Table 8, the dependent variables are topping skew, the proxy for firm value, ROA, sale growth, and patent, which is used to measure the innovation. For topping Q and ROA, the coefficient on the event time indicator year 3 to 5 and after are mostly negative and statistically significant. For example, for topping Q, the coefficient for year 5 and after is minus 0.195, p-value is 0, and for patient, the coefficient for year 5 and after is minus 0.605, the p-value is 0.05. So, this provides evidence that despite the short-term boosts in stock return, the long-run effects of legalization are detrimental to firm value, the topping Q, profitability, ROA, and the innovation from the patent. The Table 9 shows the insider ownership. And the legalization dummy is also negative and significant for both change in share number and change in share value. The event time analysis show a sharp drop in insider ownership starting in year 3. So, this suggests that the insiders are selling shares in the post-legalization period, taking advantage of the high stock prices before the long-run deterioration in fundamental performance, which typically began around year 3. Next, Table 10 explores how the legalization effect varies across different markets and firms. The study investigates 3 areas of heterogeneity. First one is market with different restrictions. From panel A, we can see the interaction term legalization and restriction is negative and significant for repurchase, capital expenditure, R&D, and Tobiscue, which means the effects of legalization are weaker in markets that impose strike price and volume restriction on buybacks. Next is the different tax environment. In panel B, we can see that the interaction terms legalization and next tax rate on dividend is positive and significant for repurchase. This suggests that legalization effect is stronger in countries where the dividend tax penalty is higher, confirming that tax advantage are a primary motivation. Third one is the different financial contract. In panel C, we can see the interaction term legalization and KZ index is negative and significant for repurchase, cash, and topping Q. This shows that the effects of the legalization are weaker for firms that are more financially constrained, as they simply don't have the internal cash to take advantage of the new policy. This page investigates the underlying motivation for repurchasing. The study tests 3 theories: tax incentives, financial flexibility, and undervaluation, and the table 11 shows the key driver. We can see that the dividend tax penalty is highly positive and significant. Operating cash flow volatility and cash flow stock are also positive and significant. So we can have the conclusion that the results indicate the repurchases are primarily driven by tax advantage and the desire to distribute temporary cash flows rather than a response to undervaluation. This page shows the comparison between purchases and dividend-paying firms. In the table top in the left hand, it presents that the t-test that repurchase firms are characterized by more temporary and volatile cash flow and lower market-to-book ratio than dividend-paying firms. And the figure 4 in the right-hand side presents that the firms which pay dividends less regularly before the legalization are much more likely to repurchase within 2 years after legalization. So we can conclude that firms that pay dividends less regularly before legalization are much more likely to adopt repurchasing, suggesting repurchases are a preferred payout channel for firms with volatile earnings or those not committed to a regular dividend policy. Finally is the conclusion. The study effectively used the staggered legalization of share repurchase across 1700 countries as an exogenous shock, and the main finding includes total payout increase with no dividend substitution. Repurchases are fine with internal cash leading to a decline in long-term investments. Repurchase boosts short-term stock return but ultimately harm long-run firm value and innovation, and the insider ownership fell in the long term. From the cross-sectional evidence, the effects are generally weaker where there are trade restrictions or for financially constrained firms, and stronger where dividend tax penalties are high. And the motivation to do the firm repurchase is tax benefit and temporary earning payout. This concludes my presentation. Thank you.